Ladies and gentlemen, good day and welcome to Carborundum Universal Limited Q2 FY’25 earnings conference call hosted by DAM Capital Advisors Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Bhumika Nair from DAM Capital Advisors. Thank you, and over to you, ma'am.
Thank you, and warm welcome to everyone on the 2Q FY’25 earnings call of Carborundum Universal Limited. We have the management today being represented by Mr. Sridharan Rangarajan, Managing Director, Mr. Sushil Bendale, Chief Financial Officer, Mr. G. Chandramouli, Advisor Investor Relations, and Mr. Dinesh Kumar, Senior Manager Strategic Planning. At this point, I'll hand over the floor to Mr. Rangarajan for his initial remarks, post which we'll open up the floor for Q&A. Thank you, and over to you, sir.
Good morning, I'm Chandramouli. Let us start the proceeding with the disclaimer class. During this call, we may make certain statements which reflect our outlook for the future or which could be construed as forward-looking statements. These statements are based on management current expectation and are associated with uncertainties and risks are more fully detailed in our annual report, which may cause the actual result to differ. Hence, these statements must be reviewed in conjunction with the risk that the company faces. Thank you.
Thank you. Good morning to all of you and a warm welcome for our second quarter earnings call for this financial year FY’24-25. First of all, a very happy Diwali to all of you. Hope this year brings a lot of wealth, peace and health to all of you and your family. Today I am joined in this call by Sushil Bendale, our CFO, Chandramouli, who handles the investor relationship, and Dinesh, who handles the strategic planning. I'll provide an overview of the company's performance for the quarter as well as the first half, and then we will open up for questions. So first to start with, I'll talk about the performance of Q2 and H1 FY’25. Consolidated financial results. Consolidated Q2 was rupees 1,209 crores. This is the highest quarterly sales. This was a growth of 7.6% compared to Q2 FY’24. This growth was contributed by all three segments. Electrominerals contributed about 6.5% growth, abrasives about 6.4%, and ceramics 5.5% growth. Compared to Q1 FY’25, sales in this quarter grew by 2.1%, electrominerals grew by 5.6%, ceramics grew by 3.7%, and abrasives was lower by 1.5%. Consolidated sales for H1 FY’25 was rupees 2,393 crores with a growth of 3.4% compared to the same period last year. The growth was contributed by growth in abrasives, which was at 6.4%. Electrominerals was lower by 1.6%, while ceramics was lower by 0.5%. Now coming to the profit before interest and tax for Q2 FY’25. Q2 the PBIT was 154 crores. This was a growth of 9.2% over Q2 FY’24. Compared to Q1 FY’25, PBIT grew by 3.4%. So both quarter on quarter as well as sequential, there is a growth. PBIT margin at consolidated level improved from 12.6% in Q1 FY’24 to 12.8% in Q2 FY’25. PBIT for the first half of the year was 304 crores compared to 296 crores in H1 FY’24. PBIT margin percentage for the first half of the year was at 12.7% as against 12.8% in H1 FY’24. Profit after tax for Q2 FY'25 was 116 crores, showing a growth of 13.7% compared to profit after tax for Q2 FY'24. Profit after tax for Q2 FY'25 improved by 2.6% when compared to profit after tax of Q1 FY'25. Profit after tax for H1 FY'25 grew by 6.4% to 229 crores compared to H1 FY'24. PAT margin increased from 9.3% to 9.6%. Now I'll cover the standalone performance. Standalone Q2 was rupees 705 crores with a growth of 9.6% compared to Q2 FY'24. This growth was contributed again by all three segments. Electrominerals contributed about 9.2% growth, abrasives 8% and ceramics 4.8%. Compared to Q1 FY'25, sales in this quarter grew by 6.3%. Electrominerals grew by 11.2%, ceramics grew by 5.2%, abrasives grew by 1.7%. Standalone sales for H1 FY'25 was 1,369 crores with a growth of 5.1% compared to same period last year. This was contributed by growth in abrasives and electrominerals at 7.6% and 2.4% respectively. There was a marginal drop of 0.8% in ceramic segment. PBIT for Q2 FY'25 was rupees 116 crores with a growth of 4.4% over Q2 FY'24. This was contributed by 8.6% growth in ceramics and 4% growth in abrasives over Q2 FY'24. Electromineral PBIT was lower by 6.2% when compared to Q2 FY'24. Compared to Q1 FY'25, PBIT in Q2 FY'25 degrew by 3.2%. PBIT of electrominerals and ceramics in Q2 FY'25 grew by 33.3% and 26% respectively. Abrasives were lower by 7%. There were unallocable expense of 17.6 crores in Q2 FY'25 compared to unallocable income of 0.7 crores in Q1 FY'25. More details on unallocable part will be covered by Sushil later. PBIT for the first half of the year grew by 0.9% to 235 crores against 233 crores in H1 FY'24. PBIT margin percentage to sales at standalone level was decreased from 17.2% in Q2 FY'24 to 16.4% in Q2 FY'25. The margin in Q1 FY'25 was at 18%. There was a small decrease in PBIT margin percentage from 17.9% in H1 FY'24 to 17.2% in H1 FY'25. Profit after tax for H1 FY'25 grew by 2.2% to 180 crores when compared to H1 FY'24. PAT margin decreased from 13.5% to 13.1%. On a quarterly basis, PAT grew by 4.4% to 86 crores when compared to Q2 FY'24. PAT was lower by 7.3% when compared to Q1 FY'25. Now I'll cover the performance of each segment. Now to start with abrasives, consolidated abrasives sales for H1 FY'25 was 1,095 crores with a growth of 6.4% when compared to the same period last year. Standalone business, Rhodius and Avuco showed good growth compared to H1 FY'24, whereas Sterling Abrasives and Fumi America had a small negative growth. Q2 FY'25 sales was at 543 crores with a growth of 6.4% compared to the same period last year. This was growth contributed by standalone, Avuco and Rhodius, including WA. Compared to Q1 FY'25, sales was lower by 1.5%. This largely coming out of the lower sales in Avuco. Standalone abrasives, Q2 FY'25 standalone abrasives grew by 8% to 308 crores compared to Q2 FY'24. Industrial segment, retail segment registered double-digit growth, while precision was marginally lower compared to last year. The growth was mainly on there was also a small negative growth in exports. In comparison to Q1 FY'25, there was a marginal growth of 1.7%. Sales for H1 FY'25 was 611 crores with a growth of 7.6% compared to the same period last year. The growth was majorly driven by industrial, retail, while there was a small degrowth in precision. The growth in H1 FY'25 over H1 FY'24 was predominantly volume-driven growth. Now I'll go to Rhodius. Rhodius in H1 FY'25 achieved a net sales of 33.8 million euro compared to 30.7 million euro in H1 FY'24. This represents a 10% growth in euro terms over the last year. There was an increase in volume, which is the predominant part. For the quarter, Rhodius achieved net sales of 16.5 million, which is 8.5% growth over Q2 FY'24. And compared to Q1, there was a lower growth of 4%, reflecting the seasonality of their business. In H1 FY'25, Rhodius incurred a loss of 0.1 million euro against the loss of 1.4 million euro in H1 FY'24. So this means the losses are coming down significantly. It is to be noted that this is after the PPA write-off of euro 1.4 million. We expect a growth of 9% on a full year basis as against 10% what we communicated earlier in the call. We expect a break-even on a full year basis against the small profit what we told in our previous calls. Please note that this would also mean a significant loss reduction compared to the last year. It is to be noted that these numbers are after the PPA write-off of euro 2.8 million on full year basis. I'll move to Awuko. Awuko achieved a sales of 5.3 million for the first half of the year. This is a growth of 18% compared to the last year same period. For the quarter, Awuko delivered a sale of 2.2 million, which is 17% growth over the same period last year. Sequentially, it was lower by 26% compared to Q1 FY'25. The losses before tax on H1 basis are at similar level as that of H1 FY'24 at 2.3 million. Operationally, Awuko improved their performance compared to the last year. We earlier communicated that Awuko would increase their yearly sales by 8 million to 10 million euro. We also said that Awuko would break even at EBITDA level and have a small loss of 0.7 million to 1 million by FY'25. Currently, we feel at full year, Awuko would increase their sales around 2 million. We expect an EBITDA loss of around 4.5 million. The reason for not achieving the planned sales are product portfolio change to more converted products and less jumbo rolls. This resulted in capacity constraint, higher lead times and cost. Focus of customer business and target market did not develop as planned. Delays in achieving acceptable levels of quality. We are working on a strategy to improve Awuko's performance. I will share more details in the next 6 months. The current Q3 and Q4 we have fully covered and I have explained. Beyond that, I will cover in the next 6 months when I come and meet you. Now I will cover the performance of profit before interest and tax. Consolidated abrasives PBIT for the first half of the year grew significantly to 90 crores from 68 crores in H1 FY'24. Representing a growth of 31%. This resulted in margins improving from 6.6% in H1 FY'24 to 8.2% in H1 FY'25. This was mainly due to standalone's PBIT growing at 13.3% and Rhodius delivering a small PBIT compared to negative H1 FY'24. Consolidated PBIT for Q2 FY'25 was 34 crores with a degrowth of 7.1% 1% compared to Q2 FY'24. This was due to PBIT degrowth in sterling abrasives, CUMI America, and AWUKO. While compared with Q1 FY'25, the PBIT was lower by 21 crores. This was mainly due to lower PBIT in AWUKO by 5 crores, RHODIUS by 9 crores, and standalone by 4 crores. AWUKO was due to lower sales, RHODIUS was due to lower sales, product mix, and the cost push. I'll move to electrominerals. Consolidated sales in H1 FY'25 was 783 crores, which is slightly lower by 1.6% compared to the same period last year. Standalone business and Foskor Zirconia showed growth compared to H1 FY'24. VAW, Russia in local currency delivered similar performance compared to the last year, but had a small degrowth when converted to INR. Q2 FY'25 sales was 402 crores with a growth of 6.5% compared to Q2 FY'24. The growth was contributed by standalone, VAW, and Foskor. In comparison to Q1 FY'25, sales grew by 5.6%. Standalone business and VAW showed growth. Foskor degrew, the details of which I will cover in Foskor section. Standalone electrominerals, standalone Q2 was rupees 210 crores. This is the highest quarterly sales. It is a 9.2% growth compared to Q2 FY'25. This growth was aided by volume increase and higher price realizations. This growth was also because of the higher export sales. Compared to Q1 FY'25, sales in this quarter grew by 11.2%. This growth was aided by volume increase and higher price realization. Sales for H1 FY'25 was at rupees 399 crores with a growth of 2.4% compared to the same period last year. This growth was aided by marginal volume increase and a small increase in price realization. The other feature of the growth is higher export and volume growth in value-added products. VAW, the operations are running well and the capacity utilizations are slightly better compared to the last year. Sales in local currency for Q2 FY'25 degrew marginally by 1.7% compared to Q2 FY'24, which I explained largely, very small marginal degrowth, and grew 1% compared to Q1 FY'25. They delivered a profit after tax of ruble 466 million in Q2 FY'25 against ruble 413 million during the same period last year and ruble 287 million in Q1 FY'25. H1 FY'25 profits were ruble 753 million compared to 836 million during the same period last year. There was no major impact on exchange rate conversion in INR in comparison to last year. I will move to Foskor. For the quarter, sales grew by 38% compared to Q2 FY'24. This is predominantly coming out of a volume increase. However, compared to Q1 25, there was a drop of 32%. China dropping the price has impacted the volumes. First half of FY'25 witnessed a volume growth of 26% compared to H1 FY'24. However, the price realization dropped to an extent of 17%, resulting in a net sales growth of 9%. Foskor Zirconia in H1 FY'25 incurred a loss of 14.7 crores compared to a loss of 6.1 crores in H1 FY'24. The increase in loss is mainly on account of strengthening of the South African rand against the US dollar in this quarter by around 10%. We have now considered the pricing pressure in the market and rolled up H2 FY'25 outlook. We feel Foskor Zirconia loss in H2 could be in the range of 2 crores against H1 FY'25 loss of 14.7 crores. Overall, the full year loss for FY'24 was 7.4 crores, and in FY'25 we expect it could be in the range of 16 to 17 crores. Now I'll cover the performance of PBIT of this segment. Consolidated PBIT for Q2 FY'25 was at rupees 58 crores. This was a growth of 33% compared to Q1 FY'25. standalone business and VAW contributed to this growth. In comparison to Q2 FY24, it was lower by 6.4%. This was mainly due to standalone and Foskers PBIT. PBIT margin at consolidated level was at 14.3% in Q2 FY25 compared to 11.4% in Q1 FY25 and 16.3% in Q2 FY24. In H1 FY25, PBIT was 101 crores compared to 136 crores in H1 FY24. This resulted in a margin decrease from 17% to 12.9%. Standalone electro-minerals PBIT decreased from 46 to 38 crores. Drop is mainly due to pricing pressure in the market. The increase in PBIT loss in Foskers Zirconia to the extent of Rs 8 crores, which was mainly on account of strengthening of the South African rand against dollar. VAW's PBIT dropped by 18 crores due to the export duty, higher freight costs, etc. That's the broad reason for the swing. Now I'll move to ceramic section. Consolidated sales for H1 FY25 was 549 crores compared to 552 crores in H1 FY24. Q2 FY25 sales was 280 crores compared to 265 crores in Q2 FY24. The growth was contributed mainly by CUMI India and America. Compared to Q1 FY25, sales grew from 270 crores to 280 crores, that is 3.7%. Standalone business and CUMI Australia showed growth. Standalone ceramics Q2 sales was 228 crores with a growth of 4.8% compared to Q2 FY24. This growth was aided by volume increase and higher price realization. Compared to Q1 FY25, sales in this quarter grew by 5.2%. This growth was mainly contributed by higher price realizations. Sales for H1 FY25 was 444 crores. This is lower by 0.8% compared to the same period last year. Fired and mono-refractories, wire ceramics and metallized cylinder business as standalone combined together grew at 14% compared to H1 FY24. Sales were lower in engineered ceramics and corrosion resistance business. Subsidiary in America on H1 basis registered good growth, whereas Australian subsidiary was marginally better compared to H1 of the last year. Now I'll cover the PBIT of this segment. Consolidated PBIT for Q2 FY25 was 80 crores. This was a growth of 23% compared to Q1 FY25. This was contributed by double-digit PBIT growth in standalone, CUMI Australia and VAW Russia. In comparison to Q2 FY24, there was a growth of 8%. This was mainly due to PBIT growth in standalone and VAW. PBIT margins in Q2 FY25 was at 28.5% compared to 24% in Q1 FY25 and 27.8% in Q2 FY24. Consolidated PBIT for H1 FY25 was 144 crores compared to 154.5 crores in H1 24. This resulted in margin decrease from 28% to 26.3% in H1 FY25. This was mainly due to standalone ceramics. Standalone ceramics PBIT decreased by 6.7% to 111 crores on account of mix between industrial ceramics and refractories and product mix within the industrial ceramics. This covers the performance section. Now I will also make a quick update on the recent acquisition that we have made. We completed the acquisition of 100% stake in silicon carbide products, a refractory product manufacturer based in Osset, at an enterprise value of $6.66 million. SCP specializes in manufacture of high-quality nitride bonded silicon carbide products and are widely recognized for their advanced firing and forming process. This acquisition aligns with our strategic expansion plan and offers synergies in the market access, technology capabilities, and raw material supply opportunities. Using SCP's expertise in furnace design, patterning, and tooling, CUMI aims to strengthen our offering in the Indian market, particularly in the critical thermal application such as power, steel, mining sectors. Additionally, we anticipate leveraging SCP's well-established customer base in Americas to introduce CUMI's product into industries such as glass, superalloys, petrochemicals, non-ferrous, and heat treatment. We expect to see further synergies, including potential to supply Cummins grade of raw materials to SCP and to jointly develop new product and technology. Additionally, this acquisition will almost double our NBSIC production capacity. SCP closed last year, that is calendar year 2023, with 4.2 million in revenue and 0.4 million in profit before tax, with a projection to double the revenue over the next 5 to 6 years based on the current estimated growth trajectory. We believe that the identified synergies could generate an additional $5 million in annual revenue by the end of this period. We are in the process of crystallizing specific synergy programs and will provide a more comprehensive update of our integration and synergies in the next 6 months. Now I would request Sushil to cover the PBIT margin, debt positions, capex, cash flows, and ROC. Thank you.
So first I'll speak about the PBIT margin. On an H1 basis, consolidated PBIT margin was at 12.7% compared to 12.8% in H1 24. This was majorly contributed by better performance in abrasive segment. For the quarter, consolidated PBIT margin was at 12.8% compared to 12.6% in Q2 24 as well as in Q1 25. Now standalone PBIT margin for H1 25 was at 17.2% compared to 17.9% in H1 24. For the quarter, standalone PBIT margin was at 16.4% compared to 17.2% in Q2 24 and 18% in Q1 25. Now I'll share the segment specifics. Abrasives, consolidated PBIT margins of abrasives on H1 basis improved from 6.6% to 8.2%, mainly because of standalone abrasives margins improving from 16% to 16.9% and Rhodius delivering small profit in H1 25. For the quarter, consolidated abrasives margin declined from 7.3% in Q2 24 to 6.3% in Q2 25. The margins dropped by 364 basis points compared to Q1 25, which was contributed by a decline in standalone margins from 17.6% to 16.1%, increased losses in Awuko, and margins moving from positive to negative for Rhodius. Now, electrominerals. Consolidated PBIT margins of electrominerals on an H1 basis declined from 17% to 12.9%. The standalone PBIT margin of H1 25 was at 9.4% compared to 11.7% in H1 24. This drop is mainly due to pricing pressures in the market. Also, losses increased in Foskor on an H1 basis, primarily on account of strengthening of the South African rand against USD. For the quarter, consolidated electrominerals margins declined from 16.3% in Q2 24 to 14.3% in Q2 25. Standalone electrominerals PBIT margins decreased from 11.9% in Q2 24 to 10.3% in Q2 25. The drop is mainly due to pricing pressures in the market. The consolidated electrominerals margins improved by 296 basis points compared to Q1 of 25, which was contributed primarily by improvement in margins of standalone and VAW. The standalone margins in Q2 25 improved by 170 basis points compared to Q1 25, mainly on account of better price realization. Ceramics. Consolidated ceramics margins improved from 27.8% in Q2 24 to 28.5% in Q2 25. Standalone ceramic PBIT margins improved from 26.2% in Q2 24 to 27.2% in Q2 25. In comparison to Q1 25, the PBIT margins improved by 449 basis points, which was contributed by improvement in margins of standalone and Cumi Australia. The standalone margins improved from 22.7% to 27.2% on account of higher price realization and favorable product mix. The consolidated PBIT margins of ceramics on H1 basis declined from 28% to 26.3%, primarily due to standalone performance. Standalone margins decreased from 26.6% to 25% due to mix between industrial ceramics and refractories and product mix within industrial ceramics. Now I'll speak about the debt position. There was no debt in our standalone books, and total debt at the consolidated basis was at 103 crores at the end of Q2 25 compared to 140 crores at the end of Q2 24 and 112 crores at the end of Q1 25. The debt to equity ratio was at 0.03 at a consolidated level. Capex during H1 of 25, our Capex investment was rupees 124 crores at the consolidated level. Return on capital employed for H1 25, the return on capital employed at a consolidated level is 17% compared to 19% during the same period last year, and at a standalone level it is at 19.3% compared to 21.5%. For the consolidated business, the ROCE in H1 25 for abrasives improved from 10.2% to 12.3%, while ceramics has declined from 51.7% to 44%, and electrominerals has decreased from 31.7% to 19.4%. For the standalone businesses, ROCE for H1 25 for abrasives has marginally decreased from 41.3% to 41%, while ceramics has declined from 54.9% to 46.8%, and electrominerals has decreased from 31.3% to 21.5%. Now speak about the unallocable expenses. At a standalone level, the unallocable expenses in Q2 25 were at 17.6 crores, which is similar to the unallocable expense in Q2 24. In Q1 25, the unallocable income was 0.7 crores. This is primarily due to dividend receipts in Q1 25. On an H1 25 basis, unallocable expenses were 16.9 crores, lower by rupees 6.1 crores compared to the same period last year, primarily due to higher interest income in H1 of 25. At a consolidated level, unallocable expenses for Q2 25 were 11.2 crores compared to Q2 24. Unallocable expenses were lower by 14.7 crores, primarily due to higher interest income in Q2 25, exchange loss in receipt of dividends from VAW in Q2 25, higher project-related costs in Q2 24, and lower spend in Q2 25. Compared to Q1 25, the unallocable expenses were almost flat. On the half-year basis, unallocable expenses at the consolidated level were rupees 23.4 crores, lower by rupees 28.2 crores compared to H1 24, primarily due to higher interest income in H1 25, exchange loss in receipt of dividend from VAW booked in H1 24, which is not there in H1 25, higher project-related costs in H1 24, and lower expenses in H1 25. Now I request Mr. Sridharan to take you through the next section related to the future outlook. Thank you.
Thank you, Sushil. So I'll just make a quick overview what we said last time versus where do we stand after looking at the first half. We communicated that our full year consolidated sales could be 9% to 11%. On the consolidated sales could be 5,100 to 5,200 crores. We maintain the same. In consolidated abrasives, we expect a growth of 10% as against 11% to 12% what we communicated earlier. This shortfall is mainly coming from AWUKO. We communicated during our last call a growth of 8 million to 10 million euro from AWUKO. Currently, we feel that full year AWUKO could rise their sales around 2 million euro. Abrasives India growth would be 9% to 11%, which is as communicated to you earlier. Rhodius is doing well in H1 FY'25. Rhodius delivered a growth of 11.6% in Indian rupees. We communicated earlier a growth of 10% on full year basis can be expected. We feel it could be 9% to 10%. We communicated about sales growth of 12% to 14% in consolidated ceramic segment. We maintain the same. For industrial ceramics business in India, we communicated about a growth projection of 13 to 15%. We expect some shortfall in engineered and vast ceramic segment. This would lead to around 12% year-on-year growth, 1% lower than what we communicated. CUMI Australia and CUMI America are doing fine. Refractory, we are confident of delivering 12% to 13% growth over last year on the back of a strong order books, which is also similar to what we communicated. We communicated about sales growth of 5% to 6% in consolidated electromineral segment. We maintained the same. WOI is expected to deliver a similar performance to last year. This is what we have planned and what we communicated to you. Growth from standalone business expected to be about 10% growth, as said in the previous call. For Foskor, H1 FY'25 did not go as per our plan. They were impacted due to pricing pressure in the market and strengthening of the South African rand against dollar. We expect H2 25 to be better than H1 FY'25. On the PBIT performance, we communicated that consolidated PBIT margins would be in the range of 13.7 to 13.8%. We expect it to drop by 100 basis points. This is mainly coming from underperformance by AWUKO in abrasives and Foskor Zirconia in electrominerals. We said that consolidated abrasives margins will improve by 100 basis points in FY'25. We expect margins to be similar to that of FY'24. Ceramic margin will be similar to that of FY'24. We maintain the same. We said that consolidated electrominerals margin will improve by 20 to 30 basis points in FY'25. We expect margins to decrease by 150 to 200 basis points from FY'24. This is mainly coming from standalone, which is facing cost push and price realization pressure, and Foskor Zirconia, which is facing pricing pressure. On CapEx side, we said that we would spend around 350 crores on a full year basis. So far, we have spent 124 crores. We feel that we would be spending about 300 crores in FY'25. To sum up, on the whole, we expect the top line to be 5,100 to 5,200 crores. We expect PAT to be about around 500 crores. We would be spending around 300 crores of CapEx. We will be debt free. While delivering the current business, we would have prepared a strategic plan for the future of CUMI. We will share about this more in future. With this, I will end my opening remark and thank you all for hearing this out. We will now open up for your question and answer. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ravi Swaminathan from Avendus Spark. Please go ahead.
Sir, thanks for taking my question. My first question is with respect to the ceramics and refractory segment. You had talked about reasonable good growth coming in for the engineered ceramics and wear ceramics, etc. If you could give more granular details as to which are the sectors which are driving the growth for these subsegments as of now. There was one large customer from whom business was impacted. How is the path to recovery over there? If you can talk about these two segments and also refractories, what is driving growth there? How is the demand from certain sectors like glass, carbon black, steel, etc.? If you can talk about that would be great.
Yes. Thank you for your question. So to start with, I would say the customer that we had impact of slower growth is picking up, and it is the trajectory of what we communicated is very much on track. So that is in control, and as we communicated, we said that calendar year 25, which is what they would focus on, the pickup will be much more, but right now their trajectory is very much on track. We are traveling as per earlier communicated, no issues. As far as the growth in ceramics and refractories, all the normal sectors that we are addressing have witnessed a growth, and we are seeing robust demand for each of them, whether it is cement, steel, carbon black, chemical industries, power distribution. All these sectors we are seeing good demand, both in India as well as overseas, which is what is driving the performance of them. So to sum it up, I think the demand drivers are largely coming from various industries that we serve.
And the metallized cylinder segment, should we kind of think of it as growing like a 15% CAGR kind of segment? I mean, mid-teen kind of growth sustainable over the next 2-3 years?
So I think we gated the ceramic business growth, as I summed up, around 12 to 15% growth. I would expect a similar type of a growth continued because it's a mix of various product subsegments which are there, whether it is wire, metallized, engineered, fired refractories, mono, prototype business. All put together is a basket of this. So I would assume that kind of a trajectory of growth should be expected.
Understood. And my last question is with respect to the competition in abrasives and electrominerals that you had talked about in the past 2-3 quarters, especially Chinese competition and in abrasives competition from paint companies, etc. How do you see that panning out? Is it same level? Has it intensified or has it come off?
So as far as the competition, let's focus on electromineral first, is that I think as far as phosphate zirconia is concerned, the competition from Chinese is severe and their pricing pressure is very much on. So that is what is pulling their sales also down, as well as the impact on their margins. As far as India is concerned, I think we see that so far we are able to pass on the cost increase that we are getting to the market, and we will have to wait and see how the second half would span from the Chinese competition. We expect, they would also face a similar cost pressure because it's a global pressure that everyone is facing. So obviously there would be their reactions to that also. But nevertheless, it is difficult to gauge how the Chinese would react. But we are working cautiously in terms of explaining things to our customer. They understand where the cost drivers are coming from, and they are in a position to pass on the cost increase that we are getting. And so as far as the abrasives, paint, is a very small sector, as I was also alluding to, is a very specialized small sector that they were focusing on compared to the whole range of abrasive products. I think that is continuing, and probably with kind of many pressures that paint industry is going through, the focus is on their core industry than, I would say, focusing on the abrasives at this point in time.
Understood, sir. Yeah. Thanks a lot.
Thank you.
Thank you. Next question is from the line of Harshit Patel from Equirus Securities. Please go ahead.
Thank you very much for the opportunity, sir. My first question is on our abrasive subsidiaries. So why was the performance at CUNY America weak in the second quarter of FY'25? If I remember correctly, the performance was weak in first quarter of FY'25 as well, as the sales had declined both YOY as well as QOQ. And similarly for the sterling abrasives as well, now the performance has been weak for the 2 consecutive quarters. Anything specific you would like to highlight on both these?
So I think, could you repeat the second question? It's on sterling. right?
Sure. Yes. Similarly, the sterling abrasives performance has also been pretty weak for 2 consecutive quarters. On one hand, the agro processing market is doing fairly well, going by the commentary of other peers operating in the same segment. So anything specific you would like to highlight on both sales as well as margins here?
Right. No, that's a good commentary from you, Arshid. I think as far as sterling is concerned, I think they were impacted largely from one particular product segment called cone polishers, which removes the husk from the rice and paddy. That is what is their business. And because of a government policy change, which expects certain percentage of rice to be returned post dehusking process, that cannot be maintained, which is probably very high and cannot be maintained by any millers at this point in time. So the millers have stopped pretty much, at least on the 2 states, which is Punjab and Haryana. This has stopped, and that is the result of slowdown, and which is what has caused sterling abrasives business slowdown, which I think probably will get corrected post policy changes, etc. would happen. As far as CUMI America is concerned, I think, they had a very good business. Even at this point in time, they are doing well. Largely, the dependence on one customer, which is, have shifted their facility from US to Latin America, and that shift has cost, it would take a year for them to stabilize because they had quite a lot of inventory at this point in time, which is going to be currently consumed. If I remove that customer and start looking at their growth is really good. So there will be a blip, which I think we very well understand. It will get back. We have invested in people in USA. 3 new headcounts were added. It's a focused market. I think it will come back very nicely. We are confident of getting it back.
Understood. Sure. So my second question is on Awuko and Rhodius. So what is the end user industry mix for both these companies? As in, what percentage of sales are derived from automobile, construction, general engineering, retail, etc. over there?
So, as far as Awuko is concerned, it is leather and wood are the 2 major industry segments that they serve. There is also a few other small segments, but this is the 2 one. As far as Rhodius is concerned, it serves a wide range of industries. Industries including construction, infrastructure related to this. This is largely, a thin wheel, and thin wheel has got a wider application in very many industries. These are the industries they serve.
The focus on the concentration on automobile industry is not very high over there?
No, not very high.
Understood. Just a small question, if I can squeeze it. You have decreased your capex guidance by close to 50 crore, from 350 crore earlier to 300 crore. So is this just the postponement of the capex, or some capex structurally we are not going to do at all?
So if you can give some timing difference, no postponement. All capex will be this one. It's because of some starting delays, some timing differences. I am just giving that guidance. Otherwise, it will be very much on whatever we plan. We will spend on each of these critical capex.
Understood. Thank you very much, sir, for answering my questions, and all the best.
Thank you.
Thank you. A reminder to all participants that you may press star and 1 to ask a question. The next question is on the line of Bhumika Nair from DAM Capital Advisors. Please go ahead.
Yeah. So just a couple of clarifications, why on, let me start with electrominerals. Now, while, Foskor is seeing a weaker than anticipated performance, but if I look at it on a standalone basis, last 2-3 quarters was weak, and we started seeing some improvement in the current quarter. And if I remember earlier, you had mentioned that there was some dumping by the Chinese rice both out here, and SIC prices had also fallen, which was impacting VAW. So if you can just comment on that, while the pain seems to sustain in Foskor, how is, there seems to be some improvement on standalone as also in VAW. If you can just throw some light on that aspect.
So I think as far as India domestic pricing pressure and competition from China is concerned, no change. It is the same. If you look at it, I think our pickup in margin is largely volume plus also a mix which helped us to pick up this margin, which is 8.5% moving to 10.3%. We expect, the cost pressure, which is largely coming out of the alumina prices going up, is impacting most of the electromineral products, which are white and brown fused, has going through at this point in time. And to that extent, I would say we will see this pricing pressure. We are trying our best to pass on in the market, but China competition is a bit unpredictable. The logics of why would they price differently, God alone knows at this point in time, because when you have a global alumina cost increase, which is very well known, everyone can read and comment about that, but at this point in time, this is what we are seeing. As far as the SIC competition from China is very mild, I wouldn't put it the way that what we are seeing here in India.
Okay. Still also in terms of, within EMD, we were looking at, high performance materials, and we are setting up the HPSIC plant. If you can just comment on that, where are we in terms of the construction? When does the plant get commissioned? How can we see scale up of that plant over the next few years, while it will get operational soon, but more from a scale up perspective, because it's a smaller project right now. If what is the feedback that you're getting from the market? How quickly can we scale it up? Will it be a long-term process to scale it up, or can we kind of scale it up much faster? So some thoughts on that, sir.
So first of all, the project is very much on track as far as the HPSIC is concerned. We expect, the first half of, we talked about December 25, is where we said we will have the full utilization will start happening as far as this project is concerned. We expect could be much earlier than that, but I think let's still maintain the same guideline as what we told. We expect, as you rightly observed, this is a small project. We expect establishing the products to start with. This is what we are currently trying to do. We have seeded this. We have sent some of the products to few geographies where we are getting reasonably good feedback, and we will wait to share with you more as we go progress on that. So far so good. I think looks interesting at this point in time.
Okay. And what about, the other areas like, say, graphene or graphite or anything else to materially talk about, any progress, or, or maybe, if you can talk about how large can this whole specialty piece become over the next 2-3 years? Any thoughts on that?
Yeah. No, I think that's what I meant in my closing remark. We would be sharing some of these details in the next 6 months as we are working on the long-term strategy on each of these areas that you talked about, plus few more areas that we have listed as well. We will share that. At this point in time, I am not in a position to share this.
Sure. Sir, on ceramics, how should we look at in terms of the margin profile? And, year two, we are working on a lot of technical ceramic aspect of the entire business. So how is that share kind of scaling up? If you can, throw some light on in terms of what was technical ceramics as a percentage of the segment revenues and what it is today and what it can possibly get to, so that we understand, how the margins might scale up. And if you can also talk about, the met cylinder capacity, where are we in terms of utilization, any plans to further expand capacity out there?
Right. So I think as far as the programs in ceramics side is concerned, all of them have hit the ground. We have construction is on the full swing, whether it is a ceramic for semiconductors, ceramic for defense is very much on, and we are progressing as per the schedule. We have also looked at few other areas within ceramics. We expect ceramics margins could go up based on these type of newer opportunities, but I am not in a position to share what kind of a growth, etc. But I would say the current profile of margins that we are seeing should continue, should improve as we start bringing these newer ones, which is what I said that step one for this year is delivering the 5,100 crores to 5,200 crores is what our current trajectory. And in 6 months' time, maybe we will share a brief profile of what are all the initiatives that we are looking at in each of these segments, what we plan to do. So that we will be able to share and maybe give some more color to these type of growth and margins, etc., and where these growths will come from. As far as the metallized cylinder capacity is concerned, I think we are very well operating capacities. We should be in the range of about 80% plus capacity utilization, and I feel that we may be in a position to increase depending on few debottleneckings, etc. I think we are very much on track.
Okay, sir. I'll come back in the question queue. Thank you.
Right. Thank you.
Thank you. The next question is from the line of Bhavin Vithlani from SBI Mutual Fund. Please go ahead.
Yep. Good morning, gentlemen.
Good morning.
Could you just help us with the ceramics breakup between refractories, the one which are supplying to SOFC, and the growth that we have seen in the first half, how the mix has changed, which, as you were highlighting, some mix change has led to margin upside. That's my first question.
So, Bhavin, generally we are not sharing the mix of ceramic and refractory within the ceramic segment, as well as the individual sub-segment in the various elements of it. But what I can share is that some of the product that we are looking at in terms of compared to last year versus this year, the share of, let's say, in engineered ceramics has picked up compared to the last year, which is why one of the margin pickup has happened. Similarly, I would say, few other sub-segments involved in that, like for example, it could be fired refractories share has also picked up. So these are individual things which probably contributes to margin pickup, if I can share with you.
Sure. Just to follow up on the ceramics, globally, when we look through the commentary of the larger grid equipment manufacturers like Siemens, ABB, and Hitachi, they are delivering 20+% growth in an industry which is used to 2% regularly. And QMI, I understand, has a significant market position in the ceramics for the switchgear application. Could you just help us understand the kind of growth?
Also is more than 20%.
Okay. And what would be our capacity utilization in this segment? Are we looking at expansion in this segment?
So I was just answering this to Bhumika. We are in the range of about 80% plus. We can improve our capacity utilization through debottlenecking can help us. We are not constrained at this stage by capacity as far as growth is concerned.
Okay. And the greenfield expansion that, or the significant, expansion that we are looking in the ceramic segment, is the metallized cylinder part of it, or the expansion is largely into the other applications like defense, as you highlighted?
So the expansion is more on the engineered ceramic side, which is one for supplying to semiconductor fab equipments. That is the first area of expansion. The second is in the protection of vehicles, that is defense vehicles, as well as which is armor as well as the body. That is the second area of expansion. Third would be some substrate-based expansion, which I have not mentioned in my capex program but this is not on the ground. It will come in future, but I think these are areas of our expansions.
Sure. On the subsidiaries of abrasives, especially the German ones, you highlighted that auto is not a larger end user industry, but auto has a ripple effect on the broader economy. The kind of targets that you had set while we had acquired of getting to 11% EBIT level, would you believe that they are now getting pushed out? And what is the effort that we are looking at in terms of greater level of supply of raw material and also expansion within the Europe for these two entities for us to achieve that 11% EBIT target?
So as far as the RHODIUS is concerned, we feel that it is still possible, and we are progressing to what we have been alluding to. I don't see any issues on that. Where we are seeing issue, which is on AWUKO, which we have not given any guidance like what you just said, but in general I am answering is AWUKO is a concern for us, where we said we could grow at least 8 to 10 million euro in this year. The growth is only 2 million euro. This is where I said that for the next 2 quarters we are feeling that this is possible to achieve. But beyond that, we would take 6 months to get back in terms of what programs that we will have on AWUKO to get back to the both growth and profitability.
Sure. Just lastly on the Russia piece, I actually missed the numbers. If you could just help us understand, give the data on what was the revenue and the profits in ruble terms for the Russian entity.
I did not share the revenue when I covered, but I did cover the profitability. I will share that. So they delivered a profit after tax of 486 million ruble in Q2 FY'25 against 413 million rubles for the same period last year. And H1 basis, they delivered 753 million ruble compared to 836 million ruble same period last year.
Sure. Yeah. Thank you so much. These were my questions.
Right. Thank you. Thank you, Bhavin.
Thank you. The next question is on the line of Saif Shorab Gujar from ICICI Prudential AMC. Please go ahead.
Thank you for the opportunity, sir. So my question is just on the cash flows and balance sheet. 1H FY'25 had a lower cash flow conversion. If we look at in current assets, inventory has a substantial increase, as well as if you look at other financial assets and other current assets, they have seen an increase. Any specific you can highlight, and which segments, say abrasives or ceramics, is causing this?
No. I think you observed very diligently, I would say. I think free cash flow is a concern, and we will get back correcting some of these areas. So the billing pattern, which is a Q2, most of what we have done is highest in electrominerals, highest in ceramics, highest in as a company, and hence the receivables or the working capital growth is on the higher side, which is what you are seeing here. We will get back to normalcy in the H2. So we will get to a normal FCF targets that we are looking at in full year basis. But H1, yes, we have missed the FCF target. Yeah.
So specifically on inventories, if you can highlight, there is an increase. So
that's what I said.
Inventory-led, RM-led phenomenon, or more finished goods only? Similarly, you highlighted for trade receivables, right?
It is mostly a raw material-led phenomenon, where some of the materials inventory have piled up, largely because we wanted to have this as a preparation for the H2, and we are also expecting some price increases in alumina, etc. So we also have ordered some of these materials in advance. So those are the reason for the inventory pile up.
Sure. Thank you, and all the best.
Thank you.
Thank you. The next question is from the line of Jasdeep from Clockwine Capital. Please go ahead.
Hi, sir. Thanks for taking my question. So how have exports done in the first half? What are the product segments and geographies which are driving exports?
So exports have done well, both for electrominerals as well as for ceramics. Abrasives had a small challenge. I would not put any color to this at this point. The geographies are largely Europe and America.
Got it, sir. And so what are your plans for integrating Indian manufacturing with your European acquisitions? Have you been able to see new product segments manufactured in India into your European business? And how has been the experience so far?
So we have worked on one particular product line where what Rhodius used to outsource from other manufacturers, where we are able to manufacture to the quality standards and the cost expectation, which is what we have now established. That's one product line that we are able to do that. We will look at scaling up, etc., as we progress on that. Then we also would like to, I think, another area of cooperation is we shared that drawn post capacity getting relocated to India, which is one of the key programs which will incorporate some of the technologies used in Rhodius would be adopted here for that line. So that will come, but that is FY'27 type of completion as far as the project is concerned.
Got it, sir. So in this one product segment where you have started manufacturing in India for Rhodius, what has been the cost reduction, that you have achieved, in the sense that if Rhodius was earlier buying the same product at, let's say, 100 rupees, now what is the price right now at which they are buying from your Indian operations?
So right now I can share that we are able to meet their cost expectations.
Got it. So broadly what you're trying to say is that you are supplying to them at the same price as they were sourcing earlier.
No, I said that their cost expectations.
Got it, sir. Thank you. That's all from my
side.
Thank you. The last question is from the line of Aditya Mongia from Kotak Securities. Please go ahead.
Thank you for the opportunity. My first question was more on the competitive angle perspective. Wanted to get a sense of across your segments where is Chinese competition versus where it was pre-COVID. I understand that there was a period when you would have benefited. I'm just trying to get a sense of versus pre-COVID periods. Where is Chinese competition at this point of time across your segments?
I think so. Chinese competition is there everywhere and every product lines. You can't single out in one area. It is there everywhere, right? Whether it is electrominerals or abrasives, whether it is India or South Africa, all these product groups and the countries have been witnessing the Chinese competition. Now to your question in terms of pre-COVID versus the post-COVID or during the COVID versus the now, I think the dynamics, I would say, what are all the things that is changing at this point in time is, look, I'm not an expert on China, but I'm just sharing what I learned is there is a demand lull in China, which makes them to sell or export to other countries, and perhaps their cost has no basis at this point in time. We do not know. We only feel that I hope they don't sell at a cash loss, which might also happen is what we are hearing at this point. So there is to some extent these type of phenomenon which most of the industries, and I am telling clearly this is not just our industry, it is many industries are facing from China. So this is what I would say at this point in time I can broadly share.
Understood. The second question that I had was more on high purity silicon carbide and applications on the semiconductor side. As in, when you think through what you want to do in that segment, what are the key kind of imponderables? Is electric vehicles the key application, and that in that context, the share of 800 volt charging systems becoming more prominent, the single biggest driver? I just wanted to get a sense of how do you think through your relevance in that segment? What are the key demand drivers? And second part of the question was, how would QME's product compare to that of competition? If you could comment on these two aspects, sir.
Yeah. So I think so today the semiconductor products are made either out of silicon or silicon carbide, and the devices made out of each of them have their own play. Of course, there's also gallium nitride is another product. Similar to gallium nitride, few other products are also available. And each of them are playing in, depending on the temperature as well as the switch, they are getting adopted to the type of material that you would use. Plus the other factor is the cost. What we are seeing is that, and which is a global phenomenon that is happening, is SiC is preferred choice of these semiconductor devices because of the high temperature application that some of these you just mentioned in your question. Hence the preference to SiC based devices. Hence the requirement of high purity silicon carbide. So this is the logic of the demand growth. As far as our product is concerned, we are competitive and at 5N level, and we are seeded some of these applications to the select manufacturers of these devices in their own application. So looks like it is performing, and hence there's the trial orders of we've started seeding these trial orders at this stage. So that is probably the best at this stage I can share.
Maybe just a last question on this part, and that will be all from my side. Typically, ceramics have had a profile of a larger overseas kind of share of business versus domestic. Do you believe the same would hold true for silicon carbide as well? And in that context, can it become a business that is sizable, maybe 3% or more of your entire consolidated top line? Can that be a possibility for the next 2-3 years?
So to start with, silicon carbide is the biggest overseas business of us. Our capacity in Russia is about 80 to 85,000 tons, whereas our capacity in India is about 10,000 tons. So we have a significant overseas share as far as the silicon carbide is concerned. Perhaps your question, if I have to assume that it is on high purity silicon carbide. Right. High purity silicon carbide is a basic venture at this point in time, very small, and most of these capacities would be consumed outside of India.
Got it. Thank you for the color and all the very best to you. Thank you.
Right, thank you. Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Ms. Bhumika Nair from DAM Capital for closing comments.
Yeah, I would just like to thank everyone and particularly the management for giving us the opportunity to host the call. Thank you very much, sir, and wish you all the very best.
Right, thank you. And I think thank you for your patient hearing. I would like to summarize one small comment is that we are trying to deliver 5,100 to 5,200 crores. We expect a PAT to be around 500 crores. CapEx program would be 300 crores. It will be a debt-free company. We would have also prepared a strategic program by then in the next 6 months. So we created a good delivering the current. We will also prepare a good future and which we will share at an appropriate time. Thank you.
Thank you. On behalf of DAM Capital Advisors Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.